All right, guys, so I'm going to go over a strategy in the SPY. In the SPY, I thought we were stuck in a range. I put this trade on. When you go to the chart, I put the trade on when we were right around in here. I thought the SPY on July expiration, it will close somewhere in this range. If we look at how much volume and how much of the actual trading has been in this range, basically since May, every time we get to 136, we see selling pressure. Today we trade up to 135.60. We're currently trading 135.60. But I think we get sellers that come into the market. I'm not a big buyer of this market. I don't think this market's going to rip to the upside. So in this strategy, I put a very, very simple strategy. It's called a condor. So in this strategy, I think that on July expiration, we'll be in this range. If we look, 80% of all the volume and all the action, the last course of the last 2 months has been within this range. So if I thought we were going to stay in this range, what could I do? Well, I could structure a strategy, and this is called a condor, where I sell a call spread. So I sell the 35 calls, buy the 36 calls, sell the 28 puts, buy the 27 puts, and it's called a condor. So anywhere in this zone, I will make money. If we're above the zone, I lose to the upside. If we're below, to the downside, I lose. So this is a trade I put on. Currently, it is a losing position, but it is not over yet. So I sold the July 135, 136 call spread and July 128, 127 put spread for 55 cents. Okay. Anytime I sell it for 55 cents, so either on expiration, I could have the call spread. This is a dollar call spread. The most it can be worth is $1. The put spread, it's a dollar put spread. The most the put spread can be worth is $1. However, not both of these can be worth money. So if we rally and we close above 135, if we get above 136, the call spread will be worth $1 and the put spread will be worth 0. If we're under 127, the put spread will be worth $1 and the call spread will be worth 0. So only one of these can be worth something. So the most the spread can be worth is the difference in strike. So the most the spread can be worth is $1. The difference in strikes, 35 to 36, is $1. So the most this iron condor can be worth is $1. So what's my risk on this trade? How do I figure out my risk? The risk is the max can be worth minus the price I sold it for. So if I put in my risk, what's the most it can be worth? It can be worth $1. Okay? What did I sell it for? 55 cents. So what is my risk? 45 cents per one lot. As we know, as we trade options, one option is equal to 100 shares of stock. So a one lot is not really 45 cents, it's $45. Okay? So the most I can lose on this trade, if the SPY rallies up all the way back to 142 or 141, the most I can lose is $45 per one lot. If we're anywhere in this range, then I can make, let's see what I can make. So let's look at my reward. The most I can ever make when sell a condor is what I sold it for. So what did I sell the spread for? 55 cents. As we know, as we just talked about, one option is equal to 100 shares of stock. So it's really $55. So now I've defined my risk versus my reward. My risk is $45. My reward is $55. Now, what I also want to look at is my break even. So let me bring up my break even. So in a condor, my break even is always going to be the price of lower strike call plus the price I sold spread for. So now that we know this, so my break-even to the upside, on this condor, there's always going to be two break-evens. Because as we said, either the call spread can be worth $1 or the put spread can be $1. So we're going to have two break-evens. We're going to have a break-even to the upside. We're going to have a break-even to the downside. So on expiration, this is the same way I get this right here. On expiration, where would the 35 calls be worth what I sold the spread for? I sold the spread for 55 cents. Where will the 135 calls be worth 55 cents on expiration? So we just do 135 plus the 55 cents, which I just said here. Break even. The price of the lower strike call, which is 135, plus the price I sold the spread for, 55 cents. So my break even to the upside is going to be 135.55. Okay, let's look at my break even to downside. My break even to the downside is going to be the price of higher strike of put minus the price I sold the spread for. Very easily, right? So I want to know on expiration, I sold the spread for 55 cents. So at what level would the 128 puts be worth 55 cents? And the answer is 128 minus 55 cents, or 127.45. So now we have our break-evens. So now we have our trade. We have a risk, a reward, a break-even. Okay? And if we go to our whiteboard, we have the Oak Rivet trading philosophy. This is our trading plan I use in every single day. And I'm going to have to line these up because, as everybody knows in the trading room, everything has to always be lined up nicely. Meticulous. So let's go to this real quick. So this is our Oak Rivet trading plan. Okay? And I've been talking about this for days now. What does the Oak Rivet stand for? The first one is open interest. This is the volume versus the open interest. And in this, I'm putting on a trade based on the chart more. So I'm not doing this based on unusual option activity. I have three sets of trades that you basically always put on. I have a trade that I put on I see a big order trade. I see a big order trade. I have another one that I put on based on just the chart. And then I have one for earnings, which I combine earnings and the chart. So what does C stand for? The chart. So in this philosophy, what does SPY chart say? And most of the time people lose money because they can't realize how to trade on a chart. They don't know what the chart is actually telling them. So what does this chart actually tell me? Well, in my opinion, 80% of the time, or maybe 90% of the time in the last 2 months, we've traded in this range. We've been in this zone. So I want to put on a trade where I keep in the zone. So from my point of view, I think the SPY chart says we are range bound between 128 and 135. Okay? So I want to put on a trade. As we just talked about, what's my risk on this SPY trade? It's $45 per one lot. Doesn't matter. Do I want to trade 1 lot, 10 lot, 100 lot, 500 lot? Okay, what's my reward? I always want to know my risk, my reward, and my break even. Okay, what's my break even? My break even, I have two of them, 135.55 and 127.45. Then I have time and target. Okay, so what is my time period? July expiration. What's my target? My target is the stock lands anywhere between 127.45 and 135.55. So this is the Oak Rivet trading plan. Open interest, chart, risk, reward, break even, time, target. So now I'm going to go back to my chart, and then I always save these pages, so anytime I want to pull any of these pages up. So basically this is what I do. So anytime I look at it, I'm going to put these all in. So the green lines is going to be where I get long, and the red lines are going to be where I get short. So I'm just going to put this in here. I bought the July 136 calls. I sold the July 135 calls. If I sold the July 135 calls, then I'll start getting short at 135. If this was expiration, okay, let's say there was a day to go, I would be short at 135, I'd be stopped at 136. And to the downside, I sold puts at 128. So at 128, I would become long stock. So let's say we saw all the way back off, and it's the day before expiration. Where am I going to be long? Well, I'm going to be long at 128. Where am I stopped? Well, I bought the 127 puts. So this is where I'm stopped. 127. So I'm going to put this in here. And then I also want to put my break-evens in there. And as we just talked about, we got our break-even points. So now I can put my break-evens into the chart. So my break-evens are 120, 135.55, okay, and 127.45. So I'm going to just blow this up a little bit so you guys can see this a little bit better. This is all at expiration. Right now, if it expired right now, it'd be right at my break even. I'd lose about 3 cents on it. So this is right at expiration. So my break even to the upside, 135.55. Okay, and I always put these in these turquoise, this teal color. I don't know. I've just been doing it for a while. And this is how I've been trading on the floor for about 11 years. I traded all this on the floor the same way. Risk, reward, break even. The Oak Ribbit Trading Plan, OCRRBTT. Break even to the downside, 127.45. So then I just save this page, and then whenever it trades, I know. And I always have to have a reason I'm making this trade, right? Why am I making this trade? Well, I'm making this trade because I think the SPY is range bound. I don't think the SPY is going to move out of this range. Could I be wrong? Sure. Have I been wrong before? Lots of times. However, if I'm right, this is what will happen. I will make money on this trade. I'm making an even money bet that the SPY stays in this range until July expiration. I could lose. Stock could go to 141. I lose. Stock could go to 120. I lose. But I make good risk versus reward bet. I think this is a good risk versus reward. I'm risking $45 to make $55, and all I have to do is stay within this range. So this is how I use this example, and this is, I go over the four of these examples a day, the Oak Ribbit Trading Plan, and I put everything on the charts to help you guys understand that this room is not only just trading, it's option education. And understanding option education, I used to teach the training program for the traders that were becoming market makers, and I realized over time that I have to slow it down a little bit. So I've slowed it